Yeah, tonight we welcome Paul. I'm not going to attempt to pronounce your last name. Blazkiewicz, very nice. Zed's are scary. Yeah, welcome down here. Octant is a local company using AI, quite an interesting application, which I'm keen to hear about. Yeah, without further ado, take it away. And sorry, one more thing. We will do a Q&A at the end, but if you do have any questions along the way, feel free to ask them.
Yeah, you got to wait for the microphone so they can catch it on the webcam. Yeah. All right, so the talk I'm going to give today is data-driven financial risk forecasting in project management. And I'm a senior data scientist working at OctantAI. All right, so in the talk, we're going to give a summary sort of a current project management industry status, what goes on at the moment. And then I'm going to show the OctantAI view, how we're sort of trying to challenge that regime or paradigm. Then I'm going to talk about things like why is it useful to understand financial risk? Because I previously used to work in industries where we deal with financial risk and model it, but I can see that a lot of the people in the project management industry aren't doing it correctly. And I'll describe why we are doing it correctly. And then I'll talk about certain new methodologies that are coming up in the project management industry called reference class forecasting. And I'll give sort of some examples where we extend it and sort of make it a bit more sexy as we go along. All right, so the current project management industry status is basically, there's a lot of managers that have optimistic, or project managers that have optimistic forecasts based on human experience. They use a lot of spreadsheets and manual adjustments. Yeah, so I was telling a joke a while ago when we spoke to one client. I said, "Oh, I reckon that guy's using the force. He hears a conversation in the hallway. Yeah, he feels this disturbance and he goes and changes his spreadsheet, and that's the update of their forecast." Yeah. As a result of that kind of behavior, you end up having these, they'll use Monte Carlo simulations, but they're uncalibrated, yeah, or they don't have the correct probability density functions, yeah. So this means that the risk models aren't calibrated correctly. And yeah, one of the problems they have is that they have this dogma where they believe all projects are unique. So there's no use in doing historical analysis and going and back testing and checking things, yeah. And yeah, and another problem is that they view AI as a threat to their jobs, yeah. And I find it funny because they don't even have data maturity. So yeah, like you can imagine, like, are you going to get sent in like the Terminator and go through everyone's spreadsheets and rip them off and fire people? You know, it's not. I don't think it's an issue for them. They need to actually sort of change their view of the world a little bit, and that's what we're trying to do at Octant. All right, so through a lot of analysis, both using AI techniques or machine learning techniques and just regular statistics, we find that there's a lot of commonalities in projects. So it's not all lost. You can go back and look at historical behavior. And what you find too in the industry, there's, or at least in projects, there's systemic risks and factors that affect project risk as well. Yeah, like idiosyncratic risks. So for example, like a systemic risk that's happened recently might be the COVID lockdowns, yeah? And that impacting sort of, or creating delays in projects. Whereas idiosyncratic risks would be the type of company culture, the managers that are working there, those types of things, yeah? Now, what we find is when we're dealing with an organization with high levels of data maturity, you can usually, they've valued their data and they've actually produced some databases and things. You can write SQL queries and bring this data out easily. I mean, you may have a large extractable set of features, yeah, that you could use in your models. But when you work with a lot of companies where they're not on that level and they're probably not even valuing their data, then that creates like a barrier to entry for them. Yeah, you can't apply your model, those very technical models with lots of feature sets in there, your large feature sets in there. Yeah, so what you need to do to actually gain access to those customers is actually reduce your feature sets, and reduce them to something which is common that they'll be collecting. So for example, you might look at things like accounting data or management accounting data, those kind of things. So here I'm going to sort of talk about why it's useful to understand financial risk. Yeah, so it allows you to value your financial exposures. Like, so for example, when I used to work at Origin Energy, yeah, you'd have things where you'd I had to run things like on the oil portfolio, I had to run models that were called a profit at risk. Yeah, so you'd have this Monte Carlo simulation, you'd calibrate, yeah, your statistical or your stochastic model to, you know, historical parameters or, yeah, some other model that you use to produce those parameters. And then what you do is you'd run this model and you'd find where your P50 was, and you'd say, okay, well, that's my expected. And then you'd go down to the P5 where you're going to make a loss. And then you'd actually report the difference. So it's possible to go down from the P50 to where I'm expected down to the P5, and that's my profit at risk. Yeah. And what happens in a lot of those companies that you have like different layers of risk management committees. And then you actually, if you breach certain tests, they'll have to go back and mitigate those risks. Yeah. So if you're in the financial industry, you might do hedging. Yeah. If you're in some other industry, you might have to change some management procedure or process that you're operating there. Yeah. Now, all right, so another thing is that some forms of risk can be controlled. Yeah. So for example, if you have some financial exposure to a commodity, you may be able to hedge it or use some insurance, or you may be able to, if you learn about that risk and other people don't know about it, you could change your contracting style. So you may be able to pass off that risk onto other people, yeah, and actually reduce your exposure to those kind of outcomes. So like an example of that is like when I worked at Origin, is in the energy industry, if you're providing electricity or gas to people, those companies are usually highly leveraged, and they don't want to breach any debt covenants ratio, so they don't want to go bankrupt, right? They don't even want to have a downgrade in their credit rating. So what they do is they hedge to make sure that none of those things occur within a certain time span or horizon. Yeah. Whereas in other industries, like, so for example, if you look at the oil industry, they're so large, sometimes it would be quite hard for them to hedge a position, right? So they may actually move the market. So if anyone's interested in sort of, commodity trading, or at least futures trading in commodities, if you're putting on positions that are more than 1% of the daily volume that happens on that day, you're going to push the market, and you're going to cause the guy on channel 10 to go out and say, oh, oil went up by so much percent because of actions of this or that. So you don't want those kind of things to happen. So a lot of oil majors just say, well, that's just a risk of doing business in this sector, and I'm not going to worry about it. But to cover themselves, they have a lazy balance sheet. So they have a lot of cash on their balance sheet, and they're not using it effectively. They're just sitting there because if a bad day comes, I got cash for a rainy day, that kind of stuff. All right, so in the project risk estimation, what tends to happen is you create this thing that's called a risk register. And this is the kind of stuff like Deloitte and people like doing, right? And they'll go around and they'll go talk, and I had to do one of these things once, and I could see how bad it was while I was doing it, but it was something we had to report, to upper management. And basically, you end up trying to get people to make guesses about the likelihood of something happening. Well, first they'd have to make up a risk. So there's a risk of this, and they'd say, well, what's the chance of it happening? This, they'd make it up, and then they'll say, I'll make up, or this could be the possible financial impact, right? So you got a whole list of things where people have made up numbers and made up probabilities related to those numbers. And then the management would go and calculate the expected outcome. And then they'd have some number to sort of discuss in board meetings and things like that. Other things they do is like accounting-based forecasts. So some places I've seen, they don't even do this. They just have one forecast. Whereas normally if you're doing like an economic forecast, you might have a best case scenario, an expected and a worst case. And then you might be able to have a discussion about what was driving these cases or what's causing them. Another thing they do is they'll build Monte Carlo simulators to create the illusion that they have a precise answer to what's going on. But again, a lot of the parameters that are going into it are basically guesses, or people have made these things up. And commonly they'll use things like a beta distribution, and even worse, they'll approximate it by using a triangle. So they'll just, so you can see that it's just sort of, show that something's happening. And the outcome of this is that the risk models aren't adequately calibrated, and anybody that's in building models in AI knows garbage in, garbage out, right? So and that's what we're trying to change in the industry at the moment. So one new thing that's happening, and it's coming out of Oxford is this reference class forecasting. So what they try to do is they try and identify like a class of projects. So we'll have rail projects or projects on civil projects or projects on roads or train, other things like that. And then they'll group them together, and then they'll do some historical analysis where they'll say, this was the original budget and this was the final outcome. And then you'll get a distribution of a cost overrun. So that's a ratio of like how much more it costs compared to what the original forecast was. Now, the thing is, that's good. That's starting to think like a little bit more like somebody in the finance industry. I want to get some historical data and calibrate my models to it. But the thing is, how do you get access to this data, right? This is all private data or company-specific data where they don't want other people to know about it. So these guys that we collaborate with in the UK, they consult with a lot of companies and government, and so they're slowly accumulating these reference class distribution sets. So here's like an example. So you can see here, I'll walk around a little bit. So what I've shown is a set of companies, that we've had to deal with, and I've shown the reference class forecast at the very beginning, the first month of the project starting, and you can see how different they all are. So and also what I've done is I've shown what the median overrun is. So they're all above 1, and then in some cases you can see, most of the time they're sort of between 70 or 80% chance of being overrun, going more than what the original forecast was. But there's even some guys, like this company D, that there's a 90% chance of overrunning. Things I might mention now is that with this reference class forecasting, when they collect the data, at the moment, those consultants, they're collecting data from many different companies on many different projects with different managers, different CEOs, different people that were operating on it. Whereas these ones that we have here are company specific. So we've got the idiosyncratic risk related to those companies in these data that we're collecting. No.
And just to ask another question, go back to that picture. What does this mean? And this is probably less about, obviously having worked with a number of companies now, you would have seen a number of overruns and what the common factors are, but doesn't this paint a very bad picture for companies estimating projects? And what do you think are the primary causes?
Yeah, you'd say that if you didn't know why they're doing it. So when you're in those industries, they're competitive. So they've got to bid cheaper to get the job. So if they give the price that it will cost, they won't get the job, right? So they're all underbidding each other. But then they have a view that we will be able to make up the difference through variations in the project, right? So I know I'm 30% under, fine. The ink's dried, the project's going. And then now we're going to try and squeeze more money, squeeze more juice out of a lemon, as we go forward through time, And so they have that view. So I've seen a lot of them where we show that, and they're not surprised because they know that they underbid things, But one of the issues I see there is that because they don't do the historical analysis, they don't know the distribution, they don't know the value or the probability of them not being able to recuperate that, And then they'll have these political, arguments whose fault it was, And you can imagine it may not be anybody's fault. Maybe a commodity price moved against them, but somebody's got to be the scapegoat in that period, So, so what we're doing is in a simpler cases where we don't have.
Sorry. You mentioned the word historical. More important than how the company is doing it now, it's whether they are actually improving or whether they are getting worse. That would be much more relevant to me in a lot of situations.
Well, you can imagine when we give them, when we start using these models, so some clients that we've used it with, their distribution changes because the distribution we're getting is related to their behavior, their way of forecasting. So as they learn more information, they start to change their forecast through time, but it's still very important to know the distribution. And they're never going to get it perfect because in the real world, there's always errors, right? But in this case, you can see these errors aren't normally distributed. Yeah, these errors have kurtosis, skew, yeah, all these big problems that people don't like dealing with. Yeah. Okay. Yeah. 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 But yeah. Yeah, I tried to ask them why their spread is so wide, and they got offended by that question the other day, because I think they don't know why. They just gave me an explanation that they're trying to make up 30%, but well, there's some kind of diffusion. You're not always going to be getting a linear trend up to 30% at the end of the project. Yeah, some things won't go against you. Yeah, yeah, yeah. With the mean, yeah, or with the P50, it's okay. Yeah. All right, so with these companies that don't have large feature sets to help us model what's going on, we then started like extending the reference class forecasting methodology, yeah? And so like I mentioned before, the distributions are not normal or Gaussian, but they're typically, they got heavy skew and kurtosis, and they show systematic biases in their forecasting techniques, yeah? But what you find, see, that's another issue with using reference class forecasting, is that when we look at the historical data as you go through the projects, they're not stationary through the life of a project. So you can imagine it's almost the same as if you got an investment, yeah? You put $1,000 in some mutual fund. Well, how's the value of that mutual fund going to diffuse through time in 1 month or in 6 months or a year? So the further out in time you go, the wider the envelope's going to be. But this works backwards, right? So at the start of a project, there's an envelope, this is the risk. But as you get towards the end of a project, when the project's finished, there should be no more risk. It's closed out, with everything's being paid, we've gotten our checks, and we're done, we walk off, yeah? So there's another thing where you've got to actually model how it changes through time. And nobody's done these models before. So we're probably the only people that know how to do it in this sense. And what you can do is then you can relate the changes in the distributions to features in your feature sets. Yeah. All right. Now there's other issues too. Like, we can get the audience to talk about it. So for example, you're talking about I'd like it to see how they're changing through time or they're getting better. But like I said, some things they can't control, or they may not be thinking about controlling, like movements in prices and things like that. Like so recently there's a problem in the construction industry that steel prices have gone up, and that's a stochastic parameter. They're not going to know exactly what the steel price is in a year's time, So so what happens is you can even have issues where instead of just looking at the historical data, you'd like to maybe even get external data that's not related to the company, and you may want to include that in the fit, So there might be certain. Now, also by having the distribution and a correctly calibrated one, or better than what they're doing at the moment, it allows us to try and calculate probability of loss if we're looking at margin distributions, and you can start and finding projects that are going to go off deep end and come network, and then the price would jump up to $12,000 per megawatt hour, And so in Origin, not only do you have these stochastic models, you have these stress models. You just say, look, if everything goes crazy, how much would I lose if I was being exposed to the worst weather possible and the most demand possible over a certain period of time, and over there, they had a window of 2 days. So they didn't want to lose $250 million in 2 days. So they had to hedge to make sure that didn't happen. And that was a thing that we'd have in risk management meetings. So, and that was a very important thing in those kind of stress situations. But see, that's not being done here in project management. Simulations that they were trying out, they'll be nowhere near the value of what they could lose in certain situations.
Do you balance the risk of losing $250 million with gaining $250 million?
It's probably not that simple because at origin, all right. So, for example, if you're a stock trader or you're saving in your super or something, well, you got some set amount and you leave it, right? So your exposure is 10 stocks, and then until you buy 20 stocks. I mean, they're paying you a flat rate, but you're taking on their risk. So you're going to manage that risk, right? And so the demand is a stochastic parameter, which is being evaluated every 5 minutes, right, on the market, yeah? And then it can do crazy things, 1 5-minute interval will go up to above 10,000, then we go down to some normal price and be hanging around, yeah? But a grouped time series cross-validation. But in essence, what you can see is that you're trying to prove to the customer, you say, okay, if you're using our model at this point in time, so that's where we do a split between the training and the test, and we say, okay, well, over the next test period, this is how we performed. But we do it again, and then basically we look at the errors that were generated, and we try and find the correct model to make sure we minimize the errors that were going through that period, yeah. And so then we're confident. Then when we do give them the model now at the end point, we can fit that whole period, and then we can let it go forward in time. Yep. Microphone.
I guess two related questions. One is like, over what time period would you be looking at data for from a company, and then do you try and model
that's a good
tail risk?
Yeah, that's a good question, because as I mentioned earlier, you're in an economic environment that's changing through time. So just because you fit a model over a long period doesn't mean it's applicable over the next 6 months. And that's sort of one of the issues we've been having to think about, different ways of approaching it, is that how to describe it? It's well, in essence, most kind of statistical models or AI models use historical data, and you're expecting the past to reflect the future, yeah. But when you're in this economic environment, the future may be changing differently to what the past was, yeah. So there's always an issue that's why I think that when we've done those calibrations, well, that's the best guess at the moment. Yeah, it may not be right. Yeah, so like, I'll give you a funny example. Like when I was working at Goldman Sachs, I contacted this guy at Origin. I contacted this guy at Goldman Sachs that I'd be dealing with when we wanted to do hedging, and I asked him, well, can you give us like the call prices on Brent crude oil, yeah, over the past year? And what I wanted to see was that with option prices, they're related to volatility, and really they're related to volatility that the traders are assuming is going to happen in the future, right? So if the traders knew that there was going to be a crash happening in 2007, yeah, after the peak oil, which was about $145 a barrel or something like that, I would have expected to see the call prices increase before that happened, but it didn't. Yeah, the prices start falling, people start panicking, when they start increasing the volatility that goes into the Black-Scholes model to calculate the price of the calls they're going to offer to people, yeah, as it's going down, yeah. So that's another thing, is that, well, we can't even trust the market to give you the right price, because the market is just a consensus. And yeah, there was another funny situation too. Like there's this organization called Platts, and they're supposed to be like an independent provider of oil prices of all the different grades, around the world, yeah. And then at one of these conferences, these meetups I had with these guys, they had like a survey, and they asked all the people, from the prior meeting, what their view on oil price was. And at the time when they did the meeting, prices were really high. So everyone's view was, above 100, yeah, they're all going. And well, 6 months later, it was $36 a barrel, right? Yeah, so yeah, even their view was rubbish, right? And these are experts or people that know what they're talking about, right? But the issue is that a lot of people, they don't sort of think stochastically. They're thinking in a deterministic fashion. So A leads to B, and then that's what they argue with people, right? Yeah, I've got friends that will argue with me about stuff like that, and they won't, compromise, yeah. But Yeah, just let them be. Yeah. So what happens actually in say algorithmic trading is that when you're mispricing things, the people with the better models that priced it better win. They take your money, right? And then you start to lose money for doing that. So what I can see is a possible outcome is early adopters that get this will be able to optimize how they're managing their projects, how they're forecasting, be able to catch losses in margin earlier. And other people that don't will just be plodding along the same old way and they'll be losing out. Whereas these guys will be able to also choose which projects they want to take. Or if they don't take it, I can maybe change the contract style to ensure that they're not exposed to these extra risks that they believe will happen in those projects. All right. And another thing I had this chart here too, is that so for this one customer that we were doing this cross-validation testing, yeah, they'll give you a set over a period, but not all projects start at the same date. Yeah, so you get, they start accumulating, overlapping the number of data points you get. But then as you get closer towards the end, well, they're dropping off. So we had to sort of stop it a bit earlier. You couldn't do it right up to the end of what's happening now. Yeah. So but there's other customers where they don't have such good data sets, and you may have to do different cross-validation. So you may just leave in your training set. You just leave a few projects out. Yeah, you'll fit the model on there, but the issue is it's during the same historical period. Yeah, you know what I mean. You'd like to do it before because that's what's going to happen in real life when it gets deployed. Yeah. Well, those two things are just, the top one's an artistic interpretation and the bottom one is actual a graph. Yeah. Yeah. Okay. So another thing is, well, when we have our distributions, we don't want to guess and say, oh, it's a beta distribution because everyone uses it, or use a triangle or some other strange shape. So what we try and do is these QQ plots. Yeah. So basically we'll have the actual percentage, the distribution of the actual percentage, and then we'll have on the outer axis what we're predicting with the P5, P10 going along, and you want it to be a nice 45-degree line, and you can see here, so when we do our cross-validation, so this is our mean, and then this is the range that we're getting out of all the other results, of the different randomly sampled tests that we did. So that gives us a good feeling that at least with our historical data, we're calibrated correctly with our distributions. Yeah. And so, just like I said a few slides ago, here's an example with one customer where there's two projects here, and using the model, you can see there's a 90, where the green shaded region is, that's a 90% envelope. Yeah, so it's going from P5 up to P95. So you should be landing 90% of the time there. The actual outcome was the black dashed line. The Octant P50 model from the P50 from our distribution is this green line. And then you can see the red line, which is the business, which is always under forecasting, from the start. But they all tend to converge towards the end. Yeah. So at the moment, we've been moving ahead pretty quick. So the most common thing most places would want to use is cost at first. But one reason is that, for example, if you go to a government agency, they may not be, they're not thinking about making revenue or margin. They're just thinking about how much does this bridge cost to build. So the cost model is going to be probably the most general thing that you do. But we also have models, for looking at the overrun in time. So we can model the distributions in time performance. And then it gets a little bit more complicated. Then we can combine cost and time dependence using sort of rank copulars, and then we can produce like cash flow distribution. So you end up getting these things that you would use in finance, where going through time, this is the envelope of the costs I'm expected to have to be exposed to going forward. Also, we also have revenue models doing the same thing as a cost model. But then when we look at the revenue and cost, there's correlations related to them too. So we also have to use those copulars, and then we can calculate the margin distribution. And what you find is the margin is very sensitive, to these changes in the revenue and cost, But of course, you've got these strange, very high skew, high kurtosis distributions, and they're moving around through the evolution of a project. So you can imagine the margin distribution is going to be some weird and wonderful thing going through time. And also, once we have the profit margin distribution, we can start selectively calculating the risk of loss on certain projects going through time. So then you're able to categorize them earlier on, and then this has been an alert or a warning system to the project managers. One unfortunate thing is that or maybe not unfortunate, but maybe it's something maybe one of you guys might have ideas on, is that a lot of the time there's people looking at these models and they think it's magic or something like that, and then they ask you what to do. So they're expecting, because they're thinking, and they use A leads to B, they're thinking, oh, I'm making a loss. Where is it? Tell me which guy to fire. Was it some business unit? Is a manager bad there or something? So they want those answers, but it may not be that simple, right? It might be a combination of things. Like it reminds me of my friend when he did aeronautical engineering. He had this professor that would fly around investigating plane crashes, and when he was giving lectures, he said most of his plane crashes are like a confluence of a bunch of things that went wrong. It's not just one thing, it's a bunch of things that went wrong. So it's very low probability, but there was a big impact, a big outcome. But then dealing with his people with low data maturity and deterministic thinking, we're going to have to try and do some kind of insights, data science kind of insights analysis, and piece together a story that they can relate to, that they might be able to sort of translate into new business processes when they're doing these things.
Just on that note, Paul, how much of your job and the value that you deliver to organizations crosses over into that sort of consulting piece of here are, sort of like a feature importance per se. If you look at their previous projects, is a lot of the values that they get out of the work that you guys do actually helping them change their processes?
I'd say the first major customer we had, they liked it, but they were very conservative. So they had warnings, but they didn't do anything about it. So it's a little bit like paper trading. You just, okay, I'll write it down. There was a warning. But then later on, they came back and they said, well, we should have listened to what the model said, and we could have fixed up that outcome and not had that loss. So there's things like that. But that's all part of people testing you out. So like there's another example from Origin. I keep talking about Origin too much, but there was like a general manager of trading. You'd think, oh, this guy should sort of be up with a lot of statistics and stuff, but this guy was more like a matriculating self-made man that played poker really well. So if you played poker with him, you were lucky to walk out with your underpants on. And then but what the issue I could see was that because he doesn't understand computer programs, because he doesn't understand those things, he's not going to make a management decision on it that may risk him losing his job. So you've got to gain trust with those people before they use it. And then even when they're using it, you've got to keep coming up and how's it going? Is there any issues or something funny happened? Oh, let me have a look at it. And so you basically, it's a consulting piece, but it's like a relationship piece. You're trying to get these guys to believe in what's going on or understand it. Because even if you give it to them, they've got to know what to do. That's why they ask you, what do I do? Who do I argue with? They don't know. So in a way, but that's a good thing if you're asking that, because you're starting to change their way of thinking. Instead of thinking that all the projects are unique and you can't predict anything because I use the force. What you do is you're saying, oh, wait a minute, like here's some indicator, here's something you can look at. It's not just one thing. I've got a suite of these things. Now you can start looking at different components or sections of what's going on, and you can start. Once you start identifying things, well, maybe you can start having chats with people around and start working out why did this really happen? Just looking at a change in the price in the accounting spreadsheet, isn't going to tell you all the information. You may need to talk to someone. It might have been some problem implication with a certain contractor and stuff. But what I say too is like when you get these large data sets or feature sets that you use with these bigger companies, that my feeling is they're not that translatable because people will have different ways of describing things in each business, right? So it's almost like you got to custom make it each time, right? Whereas doing it the way we're doing now to sort of attract these smaller people with less data is more transferable. So we have a pipeline. So now when they turn up, we're not building much at all. We're just having to make sure the data is compliant. We put it through, and then we're interpreting what we see, and we give them an explanation of what's going on or some discussion. They may ask some pointed questions, we'll have to answer them or review stuff. And then you have that cycle of sort of iteratively talking to them and sort of training them and how to think this new way. Yeah, so I think I touched on this point before about the historical versus the future. But I just like that quote my old PhD supervisor said, like, he was like a physicist, and he said like interpolation is always better than more accurate than extrapolation. Yeah, so if you're inside the data range that you fit the model, you're more likely to be hitting the target, right? Whereas if you're outside, who knows what might have happened out there? There might have been all these other processes you don't even know about yet. Yeah.
The point of extrapolating is that you extrapolate in both directions.
Yeah.
You've got a certain portfolio to invest. You've got to balance the losses versus the potential gains. Hopefully on the gain side, but you've got to, obviously minimize losses and maximize gains. Whether you spread that wide or whether you spread it narrow, whether you're conservative or non, or what's opposite conservative? I forget
Progressive.
the word. Yeah. Risk adverse.
Yeah.
There's always a way and a mean to.
Well, I'd probably retort by saying that, well, you're talking more about the project portfolio, whereas I'm talking about, well, using our model to extrapolate, we're not going to be as accurate. So even if I go backwards or forwards, it doesn't maybe ensure that I'm going to be more accurate, on that forecast I'm giving for the client. Yeah, that's sort of the more of the point that I was trying to raise. Yeah. Whereas your idea is more like diversification. Yeah, there's some things making losses, some things making profit. It would even out. And yeah. But the issue here too is because we have this big skew in kurtosis, you find that margin distributions can have a heavy long tail to the left. And so, they're really bad. Yeah, maybe you only have one or two, but there's a big impact when they happen. Yeah. All right, so I've been waffling on for a while, so it's my conclusion. So, I let you guys have a bit of a brief view about sort of what's currently happening in project management and how we're trying to challenge those views. And I've illustrated sort of new techniques, not necessarily from us, that have been introduced into the area, and how we're sort of, I haven't told you everything, but I've just alluded to how we were using it to sort of add additional complexity, for our needs of our clients. And all of that, basically our company wants to improve the financial risk management of projects. We don't want things to be running over. We want to be saving, you can imagine you save money for the government on a bunch of big highway projects where you can deliver that extra cash down to schools or other areas and things like that. So you can have more efficient allocation of resources around the place. And also we had a sort of brief discussion, about issues that affect AI and statistical models, such as like, just modeling history, the same as the future, when we're inside a non-stationary environment. So has anybody got any questions or questions out?
I guess more of a comment than a question. You asked before what you can do about convincing the clients, like what changes they can make. And one idea, I guess, is if you could work with them to build like a probabilistic graph model, that then you can try and tune your graph model.
Just so the guy doesn't know probability.
No, but like,
I find it funny too.
What you do is you obviously have a words conversation with them about like, okay, what are all the inputs, and then try and build a graph model that sort of say, okay, these are the ones you can actually control, and then you can try and use the graph model to replicate the data you're getting with this current model, and then you have some sort of causal story that you can then tell and then say, okay, well, for this project, there just wasn't anything you could do about it because there were extrinsic risks.
Yeah, well, I've thought of that. A similar thing. I just used to think of it as a flow chart. When we've done the data insight, insights into your data, we find that this happens. If this happens, maybe you should go down this path. I mean, it's a similar kind of thing. But also that's probably a bit more, has to be custom made for each company. So like I said, they've got different ways of recording. Some of them don't record certain things, they record other things. So and not only that, they're all got different personalities. Yeah, so it may work for one person that likes that type of thinking, but other people may not like that. Yeah, or yeah, there's always some person like the other day, this client, they were trying to choose which projects that we could build a reference class for this type of projects. And then the guy piped up and goes, yeah, you can do pipes, but you can't do pumps. Pumps can't be there. They're too unique. Yeah, like he just starts arguing about it. But the reality is, how do you know? Did you test it? Did you test the errors? Did you? Yeah, like I'd have more of you. Just have a go. If it's not good, well, okay, back to the blue. Yeah. Blackboard and try a new idea, or have a discussion why that didn't work. Yeah. Whereas some people are a bit set in the way, so they're the ones that are the bigger hurdles to try and push. Yeah. Yeah. Any other questions?
Given the projects you're doing are obviously capital intensive, you've touched on before with your previous work, like looking at oil prices through Platts and stuff. Have you looked much at like the cost of inputs like steel, as you mentioned before, and how they correlate or may cause it?
I haven't done those models here. I've done them in other places, but I have mentioned them to people about, well, I've more mentioned them to people as that's even worse why their Monte Carlo simulations aren't working, because they've got static prices, and there might be varying schedule lengths or something like that going through. So in essence, that's the kind of stuff that gets done in many financial kind of energy or financial industry companies, is that they'll call it like an earnings at risk. They'll have certain stochastic models, price models, or even volume models, and they'll apply it to different parts of the portfolio, and they'll put them all together through Monte Carlo simulation and correlations and stuff like that. So it's a common thing that happens outside of the project management industry. So it's another thing too. Even if you didn't do our method, you could try those methods. But the issue is like how you're going to get so for example, like you'd have to try and get correlations between things, but some of the things may not be public, right? So again, someone's going to make a guess. Also, like the part of the thing where people think projects are unique, well, you can say that, but I'd say what's happening is that maybe the weights of exposure are different on different commodities or different sections. So a certain project might use more steel, another one might use more concrete. So then there'll be different exposures for that, for those projects. But that would be something too that you'd have to sort of estimate somehow and put in. Yes. Yeah. Well, one of the examples I said, like, I'm unique, and then I said, but I fall under the human height distribution curve, like so things like that.
Every enterprise needs to collect the data.
I think firstly collect the data, but then actually look at it. So like in a way, what you're trying to transform is, it doesn't even need to be AI. It just needs to be like, have a look at what happened and try and figure out, learn something from it. If you can't learn something from it, maybe you need to call us or some consultant. You have to do some forensic analysis if you need to. But the thing is, you need to view that data as having value, and you can learn something from it so you can improve in the future. So you have this continuous improvement kind of process happening. But that's a cultural change. It's not. Certain industries use it, but not here so much.
The other important thing is that the past is not necessarily a reflection of what's going to happen in the future. You've got to look at trends. Really got to look at trends.
Very thought-provoking. Thank you very much.
I was trying to get people to think about stuff.
And I'm just sort of intrigued, like projects, it's still a very small data set, and it's often skewed, and certainly the reference class makes an awful lot of sense. I think, sort of that, and even then within Australia, I can just see I'd love to know more about your current customer base and what they're seeing as value in what you're delivering. But then also I'm wondering, what can you translate to deliver to a global service? What are you seeing in Australian customers that could translate into a predictable service that might go for a much larger market?
And I think if I can piggyback on that, if it's someone like Atlassian, maybe for less, large and complicated projects, but if you're Atlassian with Jira and Confluence, like, are these sort of technologies, starting to come out versus just drawing a chart forward, and how far off is it short of them acquiring you?
Well, for our examples, we have a competitor in the UK called Nplan, and one of their investors is Google. Yeah, so you can imagine Google's probably going to swallow them and use them somehow, in the future. But we've worked on a project with Nplan, and not together, but separately. We're being in a pilot, and we heard from different customers that Nplan was maybe not as helpful as we were. Like, we were more willing to sort of go the extra length, whereas they wanted to just really get a lot of money and charge for things. But the thing about so the thing about the IT projects, we're not. You can apply what we're doing to IT projects, but what you find with IT projects in their reference classes is that they blow out much more. They're much longer tails, like they're much worse. And so, like a CEO, Dave Porter, always says, well, if you're building a bridge or a house, there's only so much concrete you can pour, but you can just keep people churning through and writing code forever, so, and that can sort of happen, so, because you can imagine too, a lot of time, I think I get the feeling with our customers too, is like, you'll tell them one thing, but I don't know that much, they'll learn a little bit, but then all of a sudden they start changing scope or asking for new things that you didn't even promise to deliver. So that's that creep. It's the goalposts are moving as you're going forward, and that's a very common thing in IT projects. As soon as somebody sees something, go, oh, can you do this, and then they start trying to push it onto you. At some point you got to be a bit nasty and push back, and oh, this is what you're paying for if you want that.
Isn't that agile?
Yeah.
Last question. Oh, good. Make it a goodie. You've mentioned data all along the times. What data are we talking about? We're going from a range of someone exporting from Microsoft project, all their resources, their timelines, their gates and expenditure and so on?
So if you're using a big model, you could do that. But with the simplest models that we use, we try to get sort of accounting data. So you're basically showing how the costs are evolving through time, just like I showed that S curve, things with revenue, with margin, all of these kind of parts, and how their forecasts are changing through time. So it's quite small, that data set, but that's the reason for it is so that we can access those customers.
All right, I think we'll end it there. Thanks so much, Paul. Quite interesting and a little bit different to some of the other talks we've had here. So thanks for coming down.
I hope people email me with ideas, when they go home. So
you're all out of them.
Okay,
if anyone has any further questions, feel free to pester Paul before he goes. And we'll see you all next month. Thank you. Thank you, Paul.